You're watching Dukascopy TV. I'm Elaine Stenson. Australia's central bank maintained the option of loosening monetary policy further as it weighed an uncomfortably high currency against signs interest rate cuts were working to stimulate the housing market and economy. The Reserve Bank of Australia said in minutes released today of its December 3rd meeting, where it held the rate at a record low of 2.5%. Jorge Sotelo, economist with FocusEconomics in Barcelona, joins me on the line now. Enrique, the central bank maintained the option of loosening monetary policy further, saying the Aussie remained uncomfortably high. How do you respond to this?
Well, we've seen the Australian dollar following an appreciation path against the US dollar in the last 3 years, which is consistent with the effects of the quantitative easing policy implemented by the Fed. Indeed, we think that currently the high level of the Australian dollar might be due to the effect that the US dollar depreciation has been having on the majority of the currencies around the world. So in our view, the Australian dollar remains highly conditioned to external factors. In fact, despite the low interest rates that the Reserve Bank of Australia has maintained since August, if we compare those to global interest rates that are near to zero bound, Australia is still an attractive option to investors. Having said that, we think that a potential cut on the RBA monetary policy rate can have pros and cons. So I would say that on the one hand, it could help depreciate the Australian dollar and boost Australian exports, although the low level of global prices for Australian main exports leaves this effect highly conditional to external demand developments. Particularly, we think that the capacity of China or Japan, for instance, to increase their imports from Australia could be more determining on that side. And on the other hand, a rate cut could introduce incentives to the formation of an incipient housing bubble, which in this sense, the Reserve Bank has already seen some signs of price increases in the housing market, which contrasts markedly with the overall slow in economic growth, and thus suggest that prices could be departing from fundamentals. So overall, we think that the scope of the Reserve Bank of Australia to implement monetary policy in the next year is highly, and the effect that this could have on the Australian dollar remains highly conditioned by the external factors.
Growth is expected to be 2.5% this fiscal year, unchanged from the Treasury's forecast ahead of the September 7th election. Real GDP growth in 2014 and 2015 is seen at 2.5%, compared with 3% seen 4 months ago. Are these forecasts in line with your own, and do you think that they are realistic?
Well, I would say that the projections are not particularly unrealistic. For the fiscal year 13-14, for instance, the majority of our panelists are in line with the Treasury forecast, expecting the economy to grow 2.5%. In fact, for the next fiscal year, for 14-15, our panelists are slightly more optimistic than the Treasury and see the economy expanding 3%. So expectations of GDP, as we think about it, will remain conditioned by the evolution of the external sector, which is expected to improve if global demand follows the incipient recovery that we are seeing, and also if the tapering implemented by the Fed has a depreciation effect on the Australian dollar. A thing that could be slightly more worrisome here is the evolution of the unemployment, particularly the structural unemployment problem that the country is facing. Participation rates declining since the middle of the year, which seems to be dragging the economy down. However, as I said, overall, we don't see the projections too unrealistic. Indeed, the Treasury projections are in line with the central bank target for GDP at 2 to 3% for the next fiscal year, so which make us think that monetary policy will be in line with growth projections as long as inflation does not accelerate above the RBA's target.
Finally, Enrique, do you think that the central bank will leave rates unchanged in the near term to avoid a growth gap emerging?
Well, we think that the Reserve Bank is likely to cut the rates in the in the mid 2014. That's what the majority of our panelists are suggesting. But as I said, it will depend on a large extent on how the Fed implements the tapering of its quantitative easing policy, as we think that the major determinant for the Australian dollar level now is coming from the U.S. And it is certainly reducing the scope of the RBA to implement effective monetary policy to boost economic growth.
Okay, Enrique, thank you for joining me on the line today. And that's all from me for now, but do check back for more updates and interviews from the team. Bye for now.